If you've ever said, I want to buy a home, but I don't even know where to start, this episode is literally for you to answer all your questions, to walk through the first steps, the credit questions, your debt questions, your down payment questions, all of it, with a real lender who does it every single day here in Hawaii. Welcome to the Advisor Podcast. We are real estate wealth advisors here in Hawaii, and our mission is simple: to create plans to build, protect, and pass on wealth through real estate. We believe in providing you the information and options you need to make a good decision. Joining us today is Katrina Mizuuchi, a lender with University of Federal Credit Union. Thanks for joining us today.
Thank you for having me.
Yeah, happy to have you on, Katrina. So yeah, Katrina is a mortgage lender with UHFCU with more than 20 years of experience in Hawaii real estate and mortgage financing. She specializes in guiding individuals and families throughout the home financing process by developing personalized lending solutions tailored to their unique goals. In her leadership role, she is dedicated to supporting and empowering her mortgage team to deliver exceptional service and expertise to every client. So thanks for joining us today.
Thank you. I'm excited to be here.
Yeah, we're glad to have you on. We speak with a lot of lenders and a lot of different people, and the heart that you guys have to helping the community, helping these families is very touching. So we're glad to have you on to share a little bit more about that.
Thank you.
Yeah. So for someone out there that wants to buy a home that isn't sure where to start, what's the first 3 steps that you would recommend them to take?
Well, the first 3 steps, the first one would be really just to look at your own personal finances. Take inventory of where you're at. When you come to a lender, we're going to analyze your finances and we're going to tell you, okay, this is what you qualify for, but you really know what you really can afford. You know how many Amazon orders you have in a week. How many times you go to the coffee shop, how many times you eat out. And buying a home, we can tell you on paper, but you need to know what you're truly comfortable and ready to spend. Maybe buying that home means you need to sacrifice a night out for dinner once a week, or maybe having those dinners is more important to you. So, just really sitting there and to analyze what your financial situation looks like in reality.
Yeah. That's a very good distinction. And just determining what matters more. Right? What's more important to you? So, I think that's very important.
And then, the next step would be to, once you kind of have your numbers in your head, reach out to a lender, a good lender who's going to be able to not just pre-qualify you. There's calculators online that can do that for you. Today, anybody can just log on, do a search for a mortgage pre-qual calculator and find one. But, especially first-time home buyers or even move-up buyers, they really need somebody who's able to look at their finances and provide feedback as to the best solutions, the best approach to things. Really just to be there as a guide and an educator and a support system, not just somebody who spits out numbers. Because like I said, calculators can do that for you. You need somebody with the education and experience to kind of guide you on the way. And then finally would be to partner with a great real estate agent who understands your needs, isn't going to just try to sell you on the biggest house because they make the most commission. They're really there to find the home that fits your needs and fits your finances, and then negotiate for you. So you want to make sure that you interview and find a great realtor who's going to do that for you. And a good team, lender and realtor working together is really what I've seen have the best success over the years.
Yeah, it really is a team effort to helping our clients get to their goals, right? It takes a team, right? I heard you mention pre-qualifications or pre-qual. What's the difference between a pre-qualification and a pre-approval?
So pre-qualification is you come to me and say, hey, I want to buy a house. And I say, great. How much money do you make? What kind of bills do you have? How's your credit? Good, fair, bad, excellent. And I can just run some numbers I've done it on a napkin. You can just run some numbers and say, here's what you're qualified for. Rough numbers, just based off of what you're telling me. As somebody who's shopping for a home, Okay, that gets you kind of a ballpark idea. Am I looking for something smaller, something larger? Where am I looking at in a direction? But pre-approval means that you've actually sat down, we've looked at some documents together. I've looked at your income documents, whether it be your pay stubs or tax returns. We pull a soft pull credit report. So it doesn't hurt your credit scores. It doesn't count as an inquiry. We just kind of pull it just to kind of see what's on there. Sometimes there's things on there that you didn't know was on there, shouldn't be on there. And we need time to get that cleared up. So doing the pre-approval process, we look through things like that. We look at your bank statements and your assets and say, okay, here's where you're at. Here's what we need. Sometimes people are ready to go just off of that. And sometimes people need a little bit of counseling to direct them to save some money, maybe use some of your money to pay off or consolidate debt, or we need to clear up something on your credit report. All of that can be taken care of and worked out before you get into contract, so that you're not stressing in the middle of the contract. So a pre-approval, we really just go into depth and really get you ready for underwriting. For us at UH Credit Union, what we try to do is basically get you truly pre-approved so that by the time you find that property, it's just a matter of approving the property. I think from a realtor's perspective, correct me if I'm wrong, but you guys prefer a pre-approval over a pre-qualification.
Yes.
Because you know that for a pre-approval, we've pulled credit, we've looked at documents. You didn't just tell us, I'm good, trust me.
Yep.
Right? Yeah.
Yeah. No, definitely when we're helping a seller, we want to see that pre-approval, right? A pre-qualification almost doesn't really mean much to the sellers, because they haven't validated or verified any of that information. Yeah. And then real quick, just to touch on that, you mentioned soft pull of credit, because I think a lot of people, are scared to get that pre-approval because they think their credit score is going to go down. Can you maybe shed a little bit of light on that? And, what is that soft pull versus a hard pull, or how does that work?
So a soft pull is basically as if you went and just looked at your credit yourself. There's no ding to your credit score. So when the credit bureaus are evaluating somebody's credit score, they're looking at risk. That's overall what the numbers mean. The higher the numbers, the better, the lower risk you are. The lower the numbers on your credit score, the higher risk you are. So somebody who's going around and getting their credit pulled all over, the credit bureaus will think, oh my goodness, they're about to take out a whole lot of debt. They might be overextending themselves. And because bureaus don't exactly know what's going on, they can start to hit your credit score. And so there is a little catch to that. So because people understand that when you're shopping for a car loan, shopping for a home, you're going to evaluate different lenders. Most people buying a car will go to several dealerships, and each one will pull your credit. So if you get your credit pulled as a hard pull within 30 days for the same type of loan, so all for a car loan or all for a mortgage, it'll hit you as if it's just one inquiry. And that can still hurt you. It can drop anywhere from 10 to 20 points in one inquiry. However, a soft pull, it's as if it doesn't exist. We get to pull your credit and kind of take a peek behind the curtain before actually dinging your credit score. A lot of lenders do it, but a lot don't, simply because it's an extra cost. So at UH Credit Union, we don't pass that extra cost on to you. We want to really truly help you to see where you're at, because your credit is a huge factor in approval. So we want to make sure that we've got all of the information laid out in front of us.
Yeah, no, that's really good. Thank you for explaining that. I think a lot of people out there probably didn't know that, and including myself, I didn't really fully know the extent of all that. So thank you for sharing that.
Yeah.
You mentioned you are obviously in a leadership position at University of Hawaii Federal Credit Union. What's the difference between a credit union versus a bank, and how does that affect the buyer, someone who's looking to get a loan? How does that affect them?
So in general, the biggest difference between a credit union and a bank is ownership. So a bank is owned by shareholders, stockholders. Most of the time, those are investors, and all they care about is the bottom line. We just got to make money, right? There's, you hear of it all the time, banks, they're laying off, they're merging, they're doing all these different things because all they care about is the bottom line. Well, a credit union is member owned. So what that means is that when you become a member of the credit union, you have an ownership stake. So every member, every person who has an account with us is a part owner of the credit union. So think about it this way. If you have 10 people that own a home and they all live there, you all bank with us, you want to make sure that your home is well taken care of. You don't want to just be spending frivolously or, tearing up the house, right? So in the same concept, as a member at the credit union, you're going to have input. We want to, as all of us as employees, we are members as well. We want to make sure that it runs well and we do everything to give back to you. So when the credit union is profitable, we give the profits back to you as a member. It comes back to you either by way of lower loan interest rates or higher dividend rates that we pay out. So it all comes back to you. It doesn't make our CEO richer because we had a great year. Also, we have, as the credit unions locally in Hawaii, we are the lowest in fees, which means the fees that people pay. People pay fees for overdraft. People pay fees. Some people have fees just for having an account. There's a minimum monthly fee. We don't have those fees, right? We have certain ATM fees that we allow partners with, that we waive those fees. So there's a lot of fees that we waive. We are the lowest in fees when it comes to charging. So we do that to help our members. So that's the biggest difference between a bank and a credit union.
Yeah, I mean, it sounds like you're helping members on the front end or the back end, but either way, it's still helping the members.
Yeah.
Right. So that's so awesome to hear about that. So, when someone is interested in getting a loan or interested in speaking with a lender, what does that conversation with you look like, and how do they prepare for that conversation?
So every loan officer is different, but I like to just kind of sit down and talk story with them. Find out your situation. Obviously you're coming to me because you want to buy a house, but what does that look like? Do you have a family? Are you looking for something big, something small? What are your goals today versus tomorrow? Because that all will come into deciding how we strategize your financing. Is this a home that you're looking in to live in for the rest of your life? Or do you have it set in your goals that you're going to be buying this with the intention to step up and, buy something bigger in 5 years? Well, then that changes the strategy of how we're going to look at things as far as down payment, interest rate, programs. So when somebody comes to sit down with me, I usually just find out about them. What are your goals? What are you looking for? Ask them if they have questions. Because a lot of times they come in with their whole list of questions first. And I like to just kind of get that out of the way. And then the conversation just kind of goes from there. Once we've established, kind of have a baseline of what they're looking at, then I start getting into the qualifications part and asking them about their employment history. And again, just real casual employment history, how long have they been there? What kind of income do they make? Do they have, stability? And if I find things in there that are red flags, I'll talk to them about it. Because it's not just about, is it a red flag for underwriting and for an approval? We want to make sure that we set them up financially for the long run. I don't want to put them in a mortgage if their job is very unstable. We need to make sure that we plan for that, not just to get your loan approved, but to make sure that financially down the road, you don't come back to me in 2 years and say, oh my gosh, I can't pay my mortgage. I don't ever want that. So I want to make sure that the clients are well prepared financially for this commitment that they're about to make. And then we'll proceed into an official loan application and go with the process from there.
Sounds like a pretty easy process.
Yeah.
Yeah. And I'm sure when you meet with clients, they ask you things and you're like, oh, that's, where did you hear that? Because that may not be true. Mm-hmm. So what are some of the biggest misconceptions that buyers believe about lending, about finance, that just isn't true?
I think the two biggest misconceptions would be the 20% down payment and you need perfect credit. Living in the market that we live in Hawaii, it's almost impossible to have a 20% down payment on your own. I mean, on $1 million home, that's $200,000. Most people don't have just $200,000 saved in the bank, and as hard as you may try, it's not easy to save that. So having 20% down isn't a necessity. You can get loans. There are some loans out there as little as 0% down. We offer loans as little as 3% down. There's also a lot of different avenues to get down payment assistance or programs that help with that. And there's different ways that we can assist with, making that qualification a little easier. The other misconception is a perfect credit score. So while it's true, the better the credit score, the easier it is to get approved, we understand that that's not always the case. And there's a lot of factors that someone would have less than perfect credit. Something as simple as their balances are a little bit high on their credit cards. That's a quick fix, But even at that, we don't need perfect credit score. What we're looking for more in a credit is, your history. And sometimes if you're not quite ready today, when we sit down, we'll come up with a plan and say, okay, so here's what we got to do. If you're willing to work with me on this, we can get you ready for, a loan in 6 months, maybe a year, maybe less. It just really depends on what the plan is. But it's definitely something that we can work through.
Wow. So you guys will actually help them improve their credit so that they maybe can afford something in 6 months, a year, or even more maybe.
Yes, I have somebody that comes back to me every couple of months and says, okay, are we there yet? Are we there yet? And I love her determination. She's on board. She's doing what she needs to do. And she's the homeowner that we want to give a loan to because she's committed to the process and she's going to pay her mortgage. Those are the people that we can work with.
That's so awesome because I think a lot of people out there think, oh, if I'm not approved now, then the lender's not going to want to talk to me. Why would they want to talk to me for? Right? Kind of get out of here. But that's so cool to see that you're actually willing to help these people improve their credit. So hey, maybe not right now, but down the road, they can reach their dream of, home ownership here in Hawaii.
Yes. At UH Credit Union, we firmly believe that it's an education process, that we work together. You're not just another customer, you're a member. So, you are a member of our credit union. Our job is to not just sell you a loan. Our job is to help you through your financial, situations, whether it be opening up a checking account for your kids or getting their first credit card or buying a home. We're here for you and educate you through that process. And I think that a lot of financial institutions, they get away from that nowadays, and it's more transactional and not relational. And I think that's one of the things that we're really known for at UH Credit Union is being very relational with our members, and we pride ourselves on that. You're not just a number to us. When you call us up, it's not just Randy Ihara, account 12345. Okay, what do you want? It's how can we help you? We'll sit down and talk to you and figure a way through things.
That's so awesome. Yeah, that's definitely kind of an anomaly, in today's market where everyone's kind of focused on the bottom dollar. You're really looking at how can we serve this member, right? Kind of welcoming them into the family.
Yes.
Yeah. So speaking of credit, what kind of credit score do you need to be able to buy a home? And maybe my credit score isn't great now. What's the fastest way to improve that credit score?
So as far as minimum credit scores, there's no magic number. Ideally, though, we want to see something in the 620, 660, or 680 range at least, depending on the program. Every program has its own requirements. So it'll depend on the program. But if you have a lower credit score and you want to increase it, maybe you are qualified, but because of that credit score, your interest rate isn't ideal. So we want to work on improving your credit, or just it makes good sense to have good credit, just overall. So we can work with you on that. And I think one of the fastest and easiest ways that people can improve their credit is look at their credit card balances. So a big factor is what's called your revolving credit usage. So we look at the credit bureaus, when they're figuring out your score, they're going to look at your overall credit limit. Say you have a credit card that's a $10,000 limit, but you have $8,000 of that limit used. So you're at an 80% usage. Someone who's got only $3,000, so 30% usage, is going to have a much better score than somebody who's at 80% usage. only because they see that as a high risk. You're about to max out on everything. We give you all this credit, but you're going to use it all. So one of the easiest things to do is to, bring that ratio down. That can be accomplished either by paying it down. I wouldn't suggest paying him off because that can also hurt you.
Really?
Yeah. Paying them off, or especially paying off and closing credit cards, that can actually end up hurting you. I know it seems counterintuitive,
Yeah.
but then they don't know what to make of it. These are all algorithms in the background. So then the system is going, wait, what's going on? He had all this credit. Now he's paying it off. What's going on? I don't know how to, I have no information to determine whether or not he's a good repayment of debt. So if you pay off all your credit cards and you're all cash, then how does the algorithm know whether you're good at paying back your debts?
Wait, so are you saying that I shouldn't pay off my entire credit card like in full?
You can pay it off in full if you continue to use it.
Okay.
But if you pay it off in the attempt to get your credit score lower, and you don't have a history of paying off and reusing it and paying off and reusing it, then the system has a hard time understanding what you're doing. So if you wipe out all of your debt and you have no debt for that system to kind of recognize, then it doesn't know what to make of you. So people will say, oh, but I have a car loan, which is true. It does help in your repayment history, but a car loan is typically an installment loan, much like a mortgage. And so it's viewed at differently than a credit card. A credit card, your payments from month to month can fluctuate.
Yeah.
Right? A car loan is usually pretty set. So are you able to manage those fluctuating payments? Now, when you borrow money for a car loan, it's taken out all at once. So you know what you're getting into for budget-wise. But when you spend money on that extra dinner or the take that trip, that vacation, are you able to pay back that money that you borrowed unexpectedly? That's what the algorithms are kind of looking at. And so that's a big piece of what makes up your credit score. So one, like I said, you could pay down your credit cards. The other option is if you have, a good history with those credit card companies, write to them, call them, well, maybe not write to them anymore. You might call them, go online. I think you can even do it through the app on some and just say, hey, I'd like to increase my credit limit. So you have a 10,000 limit and you have 8,000. They bump you up to 15,000. I can't do the math off the top of my head, but that's a little over 50% usage. So, you're in a much better situation. So if you did have to pay down to get it to 50% or 30% credit usage, it's a lot easier to get to that percentage than if you're at a 10,000 credit limit, right? So you can kind of bump those up together. I've had people that they've had that $3,000 credit limit forever because they got their credit card when they were 20 and they just never sought to increase it. But they go and they ask for an increase, and based off of their income today, they're able to get like a 10,000 credit line. They didn't have to pay a single penny off. They just immediately changed that percentage usage just by increasing their credit limit. Now, that doesn't mean increase your credit limit and now let's go, let's take a trip. It means keep your same usage, but utilize that to your advantage to increase your credit score. And sometimes we can see that in as little as 1 or 2 credit cycles.
Oh, wow. Yeah, when I first got my credit card, I would almost be maxing it out, but I'm like, yeah, I'm paying it all off in full. Like, doesn't that show that I can pay more off I'm responsible with that? But when I found out that actually is bad, I was like, wow, like, that's so crazy. Like, I thought it is counterintuitive, like you said, yeah.
The credit companies, they want you to use it.
Yeah.
They want you to, and so if you can utilize it and, you pay it off. We have this new credit scoring that came out. It's called like trended data. So they do look at your payment history patterns, not just the balances at the end of every month. And that's another thing to consider is when we pull your credit report, it's taking a snapshot in time. So when we pull your credit report, it may show that your credit card balance is $5,000, but you just made a payment yesterday. And so when we pull it though, it shows the balance, and it's basing your credit score off of that, which is also why if you go to a lender today and then another lender a couple of days from now, you can have totally different credit scores.
Wow. Okay. So walk us through this. Like if I know that you're going to pull credit, should I pay off my debt or should I leave it? Like what?
Leave it.
Okay.
Leave it. Because when you pay off debt, that means you're taking from your assets. Now, it's your lender's responsibility to be able to direct you as to the best usage of those assets. Mm-hmm. Is it better to pay off your credit cards and get your credit score up? Because if you already have like a 740 credit score, and paying off those debts might bump you up a little bit, but your interest rate and everything, nothing changes, your qualification doesn't change, then why? Why bother, right? But maybe that money could be better used towards your down payment. Or it could be used to buy down your interest rate and get a lower interest rate, which would then benefit you for the life of the loan. You know, you pay your credit cards down now, that saves you today, but how does that help you in the long run?
Yeah. Wow. That's awesome that, you know, you're looking at that, right? Because, you know, most people out there, including myself, like I wouldn't know what to do, what debts to pay off, and all of that calculations that you guys are doing on the back end that, you know, we don't see. So
yeah, we will look at it and say, okay, if we took, like say they got $20,000 in credit card debt. Okay, if we took that $20,000 and paid it off, how would that impact their monthly payments and how does that impact their qualifying? Okay, that's scenario one. Now we took that $20,000, leave their credit card debts where it's at, and we applied it to the down payment and lowered their loan amount. How would that look? Okay, that's scenario two. Now, what if we took that $20,000, had the higher loan amount, kept their credit card debt, and used that $20,000 to buy down their interest rate? How does that look? And what does it look like, not just in the monthly payments, but down the line for taxes and all of that kind of stuff, those benefits? How does that look for them? And that's really being able to compare the three. And for some people, it has to be one of those scenarios. Like we have to get your credit card debt down or we can't qualify you, you know? But then other people, they're in that situation that's like, well, I mean, either thing that you do, or you could just hold on to the $20,000. Like it really doesn't matter, you know? But it's being able to work with an experienced lender who's able to provide you that guidance. I always tell my clients, it's my job to present the information to you and walk you through the thought process. Your job is to make the decision. This is your home. This is your mortgage. I'm not paying it for the next 30 years or however long you get it. You are. So you have to make that decision. It's my job to present information and guidance so that you can make the best decision for you, not for me.
Yep. Yeah, that's so great. You know, I could spend the next 20 years, you know, learning about all these things, or I could just ask Katrina, right? Yeah. Second one's so much easier, right? So I'm going to do that. Let's talk about debt. You know, I think, you know, people that have student loan debts, you know, maybe credit card debt, like how should people think about that? Like maybe I have too much debt where I can't purchase, like what? Guide us through someone who has debt and maybe how they should resolve their debt, or maybe it's good debt, right? Can you help us maybe unpack that a little bit?
So I'm actually working with someone right now. They've got a lot of debt. It's not bad. They went to school. They've got a family. You know, they travel. So they have debt. And what we're looking at is restructuring it. Trying to, you know, really go through their credit card statements. What's your interest rate? You know, well, maybe we could refinance some of these credit cards into a lower interest personal loan. You know, your monthly payments might be about the same, but in the end, you're going to pay it off a lot faster because the interest is lower. You're just kind of restructuring that. I wouldn't say that excessive debt should stop someone from looking into home ownership. Again, that's where turning to a trusted lender really comes in handy because, I mean, I've pulled credit reports and I've done analysis for somebody who's got over 20 liabilities, 20 different, you know, accounts on their credit report that I need to kind of sift through and decide, okay, do we want to pay this one off or do we want to pay that one off? Do we refinance the car because their car loan is, you know, really high interest rate, or do we leave it, you know, and really just going through that. Or sometimes it's just a matter of, okay, you have a lot of debt, but we can work with that. Sometimes we don't even have to do anything prior to going into it. A lot of debt does complicate the file, but it's not necessarily a bad thing.
That's so, people hear debt and automatically think it's bad, right? Like, how does that work? Like, what is good debt? Like, what would you...
I mean, there's different schools of thought on that. Some people think that, like, you should never have a mortgage. You should just buy everything in cash. Don't charge anything. There's no such thing as good debt. But I think it's a matter of leveraging the availability of funds to your benefit. So again, kind of getting back to the scenario about, I got $20,000. Do I want to pay off credit cards? Do I want to pay down my down payment or get a lower interest rate? How you use your credit, student loans, I think that's a good debt as long as you pay it back. Who wants to start their career off as an adult with, out of pocket $50,000, $70,000, $80,000 a year just to get their education so that they can work? But you're utilizing the benefits from like the federal government, the student loans, even private student loans. You're utilizing that benefit, which oftentimes the interest rates are deferred or, subsidized until you graduate so that you can get your education, get started in a job, and then you start repaying it back. If we didn't have those programs available, that kind of debt available for students, I can see a lot of people not going because it's like buying a house. If you had to buy a house in cash, I don't think many of us would own a home.
Yep.
So if students had to pay their tuition out of pocket and there was no option, I don't think we would have as many people going to college and getting educated.
Yeah.
So those types of debts are good. Car loans, I think they're good. Credit cards are dangerous. It really just depends on how you're using it. If you get the credit card and then you pay it off every month, so you're not paying interest, I think that's a great usage of credit. Even if there's an interest rate on the credit card, if you pay it off within the 30 days, you don't get charged the interest. So charge it and pay it off. I think people who can diligently use their credit card in that fashion can benefit from it. But people who charge things that can't pay it back, that's dangerous. Using it like your checking account, that's dangerous.
Yeah. Okay. Let's kind of switch gears into down payment. How much down payment do I need? Like, I can't put 20% down. Like, that's too much. Like, what are some options for people out there? And like, what is that down payment that they should shoot for, or maybe that they should at least be a minimum of?
So we have programs for first-time homebuyers with as little as 3%. And that's great. That gets them in the door. And speaking of first-time homebuyers, we have special programs for them that gives them a discount on their interest rate by letting them buy down that interest rate permanently to help them qualify. And so we can do as little as 3%. I would say that the typical minimum that is, that you want to see out there is 5 to 10%. 3% is good, but depending on the price of the home, that means that 97% is being financed, and that mortgage can be extremely high. So again, it's not a one size fits all. So somebody who maybe recently graduated medical school and they got they're a doctor and they have a great salary now, which prior to this, they were going to school, so they were broke. They're paying back their student loans, but their income is, higher than the normal. Well, maybe for them, putting the 3% down with a high mortgage payment might be doable because of the profession or the job that they're in, versus, somebody who still just graduated college and doesn't have the money for the down payment, but, they're not making the same amount as somebody who just graduated medical school. You wouldn't want to overextend them into having that high payment. So, people who, I say this because like my daughter is hopefully going to be going into medical school. She's going to rack up a whole lot of debt. When she gets out, she's not going to have any money saved for a down payment. So having a program like this to help her get into the home, putting that 3% down, she'll be able to carry the payment, and that's fine. Either way, we're going to have to qualify you for the payment. Yep. So, that has to happen either way, but having that down payment, somebody with 3%, in that higher payment, it'll work out. Does that make sense? I don't know if
that does make sense. Talk to us about your guys' first-time homebuyer program. Like, what are the benefits? How is it different from maybe another company that says they have a first-time homebuyer program? Like, walk us through that.
So our first-time homebuyer program, depending on the situation, the borrower's income limits, we have different promotions available for them. So if you are at or below the area median income limit, you'll get up to 1 point off of your points. So 1 point is equal to 1% of the loan amount. But what they often do is instead of taking that money back, they will use it to buy down their interest rate. So they can get a lower interest rate, which helps them to qualify overall. If they make more than that area median income or AMI, then we still have a discount for them. It's just not as much. So that's the big piece of our first-time homebuyer program. But we also have flexible underwriting guidelines, which allows for, higher debt-to-income ratio because we understand that they're first-time home buyers. We have the higher loan-to-value or low down payment options. So those are all the different benefits that we offer for our first-time home buyers.
Where does that 0.5% or percent, where does that come from? Like, how do you guys do that?
It comes from us.
Wow. So when you say it comes from us, like...
The credit union.
Is helping to pay for that?
Yeah.
Wow.
So it comes out of our bottom line.
Wow.
It's just something that we give back.
Yeah. I don't know if there's anyone who does that. I've never heard of that.
I mean, there's first-time homebuyer programs out there. Some do different types of promotional rates or discounts, but not to this amount.
Yeah.
You're getting a $500,000 loan. That's $5,000 that the credit union is giving back to you in order to get yourself a lower interest rate so that you can qualify for that loan and keep you. As a first-time home buyer, we want to make sure your payments are manageable. Mm-hmm. So we're going to keep you in those programs to help keep your payments low.
Yeah, because I've heard of like the Hawaii Home Ownership Center. Those are like government funded, mm-hmm. So that's where the money comes from. But I've never heard of like a credit union, a bank, or any type of lender that's willing to actually do that, right? Because that directly affects how much you guys make, your bottom dollar.
It does. Yeah. It's something that we were cautious about at first, but in the end, it hasn't hurt us, and it's helped us. It's actually helped us to build that relationships with our members and to have them see us as a trusted advisor. This is something that we're willing to do to help get you in. We believe that home ownership leads to more stable communities. People who live in communities that own their home and are surrounded by others who own their home, they're just more likely to pay attention to their surroundings, care about the roads, care about the people, care about people walking on the street, and help them because it's your community. It's where you've set your roots. And if we can get more people to set their roots in Hawaii, then that will help to just build a stronger community all around and support everyone and support our businesses so that people don't have to leave. Mm. And then we lose all of our local people and we lose the aloha spirit that comes with it.
Amen to that. Amen to that. Yeah, that was so good. I love that. Yeah, it's really the backbone of our economy, of our community, everything, right? It just builds on top of each other.
Yeah, homeownership is so important. Pride of ownership. People want to be involved where they live. Mm-hmm. So, yeah.
That's so good. That's so good. To wrap us up here, what's something that you think is one of the biggest mistakes that people make that's avoidable, that you see happening that kind of sets people back in their home buying process?
I think we kind of touched on this earlier, paying off their debts before talking to someone. Mm. You can go online and pull your own credit report. Or there's all of these services that say, you can get your credit, monitor your credit. I mean, if anybody's ever been a fraud victim, of some large company, they get their free credit report every year. So if you do that, people will look at it and go, oh, I need to pay off my credit card debts. And once you've paid that credit card off, you can't go back to that credit card company and say, hey, you know what? I changed my mind. Can I get my money back? My loan officer said it's better that I put this money in towards my down payment. And once it's done, it's done. And some people will pay it off. Like, you didn't know that paying it all off completely and closing it possibly could actually end up hurting you. And once the damage is done, it's done. Then you have to reestablish credit. So I would say people playing loan officer is one of the biggest, most avoidable things, or talking to people who think they're a loan officer. Family and friends mean well. I know it. They mean well. But they don't always have the most current information or the most sound advice. Just because Auntie bought a house doesn't make her a loan expert or a real estate expert. So yeah, just really seeking the advice before you actually make any permanent changes.
Yeah, because once you do it, you can't take it back.
Yeah.
Yeah, so you want to make sure, you speak to someone like Katrina that can guide you to make those good decisions. Yeah. Beautiful, beautiful. Anything else you want to mention before we wrap up here?
No, I think the biggest thing is that, when you're shopping online, looking for a mortgage, don't trust whatever you see online. Oftentimes, the rates that you see online, they're marketed for general situations and they're presented as best case scenario. So when you're shopping online, it's so important to talk to a loan officer because they really know the ins and outs of their programs and they can get you the actual rate that applies to you. And then just partner with somebody who really knows what they're doing and is going to be there as a trusted support for you through the process. Buying a home is a stressful process. But people like you and I, we do it every day. So we know how to navigate through the contract requirements. We know how to navigate through all the different ins and outs of it and let us take on that stress. Don't try to wear that hat. You need to focus on, finding the home that's going to be your home for your family and let us deal with the details of how to get that done.
Yep. You have your job, we have our job.
Yes.
And, we can do our job pretty well. So yeah. Awesome. So for people out there that's listening that, want to speak with you, Katrina, or want to get connected with the credit union, how should they do that?
Oh, well, you can call us, 808-983-5500. Or you can go online at www.uhfcu.com, at uhfcu.com. Yeah.
Awesome. We'll make sure to put that in the description as well. So if anyone is interested, I'll go ahead and reach out to them. They can be a great resource for you. Well, thank you, Katrina, for joining the podcast.
Thank you for having me.
Yeah, awesome. We'll see you guys in the next episode. And of course, if you liked what you heard, go back, listen to our previous episodes, or you can reach out to us in the link in the description as well. Alrighty. Thanks, guys. Take care.